5 Powerful Warren Buffett's Ways How to Make Money Work Hard for You. Hello everyone. Welcome back to the Financial 911 channel. Today, we have an exciting topic that many people are interested in: 5 Powerful Warren Buffett's Ways How to Make Money Work Hard for You. We're about to embark on a journey into the timeless wisdom of Warren Buffett, one of the most successful investors of our time. Today, we will explore the strategies he employs to make money work for him. So, without further ado, let's jump right in. Who is Warren Buffett? Warren Buffett is one of the most successful investors in the world and has long been admired for his ability to make money work hard for him. With a net worth of over $100 billion, Buffett has consistently demonstrated how to grow wealth and achieve financial success. In this video, we will take an in-depth look at Buffett's strategies and learn how to make our money work hard for us too. The wisdom of Warren Buffett. Our journey begins with the wisdom of Warren Buffett. He once said that money should work hard for us. Let's explore the philosophy behind this and how it shapes the mindset and actions of the wealthy. Warren Buffett's philosophy is more than just a quote. It's a guiding principle for those aiming for financial success. To understand this philosophy better, let's explore how it influences the mindset and actions of the wealthy. By making money work hard for them, they have achieved remarkable success. Now, let's break down the key strategies that the financially successful employ. 1. Power of compound interest. Warren Buffett's financial success is intricately tied to his profound understanding of the power of compound interest. At its core, compound interest is the engine that propels modest investments into substantial wealth over time. Let's dive deep into this concept and uncover why Buffett considers it a fundamental force in making money work tirelessly for him. Imagine you invest $1,000 in an investment vehicle that yields a 5% annual interest rate. In the first year, you earn $50 in interest, bringing the total value of your investment to $1,050. However, in the second year, you don't just earn 5% on your initial $1,000, but on the accumulated total of $1,050. This means you earn $52.50. $52.50 in interest in the second year, bringing the total value of your investment to $1,102.50. This compounding effect continues to snowball, creating a powerful wealth-building cycle. Now, let's extend this over a more extended period. Over 10 years, your initial $1,000 investment at a 5% annual interest rate would grow to approximately $1,628. 100 years? You'd be looking at a staggering $131,501.26. While we may not all have the luxury of a century, the principle remains. The longer your money compounds, the more significant the impact on your wealth. Buffett's genius lies in understanding the exponential nature of compound interest and having the patience to let it unfold over extended periods. It's not about making quick gains, but rather about allowing the mathematical magic of compounding to work its wonders. Buffett often likens compound interest to a snowball rolling down a hill, gaining size and momentum as it goes, an apt metaphor for the continuous growth potential inherent in wisely invested money. So, when Buffett stresses the importance of a long-term perspective in investing, it's not just a catchphrase. It's a strategic approach rooted in the belief that time is a crucial ingredient in the recipe for financial success. By harnessing the magic power of compound interest and adopting a patient investment horizon, you, too, can set the stage for your money to work diligently and exponentially multiply over the years. 2. Long-term investing. Warren Buffett's commitment to long-term investing is not just a preference. It's a fundamental philosophy that has played a pivotal role in his unparalleled success. In this segment, we'll unravel the nuances of why Buffett advocates for holding onto investments for the long haul and explore the myriad benefits of this patient approach. One of the primary advantages of long-term investing lies in its ability to weather the storms of market volatility. Financial markets are inherently unpredictable in the short term, subject to fluctuations influenced by a myriad of factors, economic data, geopolitical events, or simply investor sentiment. Buffett's strategy involves looking beyond these short-term fluctuations and focusing on the underlying value of businesses. By holding on to investments through market ups and downs, you allow time for the market to reflect the intrinsic value of the companies you've invested in. This aligns with Buffett's famous quote, "The stock market is designed to transfer money from the active to the patient." It's a reminder that impulsive, short-term trading often leads to suboptimal results, as emotional decision-making can cloud judgment. Additionally, the power of compounding, as discussed in the previous segment, is accentuated in long-term investing. The longer your money is invested, the more time it has to benefit from compounding returns. This extended time horizon can transform even modest investments into substantial wealth over the years. Buffett's Berkshire Hathaway, for instance, has held iconic investments like Coca-Cola for decades, allowing the power of compounding to work its magic. Furthermore, a long-term approach encourages a buy and hold mentality, which has additional advantages. Transaction costs, taxes, and the emotional toll of constant trading are minimized when you commit to holding onto investments for the long term. Buffett's success is not built on frequent buying and selling but on astute, well-timed investments held over the long run. As an investor, adopting a long-term perspective means focusing on the fundamentals of the companies you invest in, understanding their competitive advantages, and having confidence in their potential for sustained growth. By doing so, you align your investment strategy with the principles that have guided Warren Buffett throughout his illustrious career. So, the next time you hear the phrase, "Our favorite holding period is forever," remember it's not just a slogan. It's a strategic approach that has proven to be a cornerstone of Buffett's financial wisdom. 3. Quality over quantity. Warren Buffett's investment philosophy has always emphasized quality over quantity, a principle that sets him apart in the world of finance. In this segment, we'll delve into the rationale behind Buffett's selective approach, exploring why he favors a concentrated portfolio of high-quality investments and how you can apply these principles to your own investment strategy. Buffett's focus on quality starts with a meticulous evaluation of the companies he considers for investment. Instead of casting a wide net and diversifying across numerous stocks, he prefers a concentrated portfolio of businesses with a durable competitive advantage, often referred to as an economic moat. When Buffett looks for quality investments, he seeks businesses with a proven track record of stability, consistent earnings, and a competitive edge. One of his famous quotes encapsulates this sentiment: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." To apply Buffett's quality-centric approach to your own investments, it's crucial to conduct thorough research on the companies you're considering. This emphasizes the importance of prioritizing the quality of the underlying business over the current stock price. Look for those with a competitive edge, a history of consistent performance, and management teams with a proven ability to navigate challenges. Pay attention to financial metrics such as return on equity, debt levels, and free cash flow, factors that reflect the underlying health and stability of a business. By adopting a disciplined and focused investment strategy, you ensure that each investment has the potential to deliver significant returns over the long term. It's about quality, not quantity. While the temptation to diversify may be strong, Buffett's success demonstrates that concentrating your investments in a select few high-quality companies can be a more effective path to wealth creation. So, as you navigate the world of investing, take a page from Warren Buffett's playbook. Prioritize quality over quantity, focus on businesses with enduring competitive advantages, and build a portfolio that stands the test of time. In doing so, you'll be aligning your strategy with one of the most successful investors in history and setting the stage for long-term financial success. 4. Economic moats. Warren Buffett's concept of economic moats is a cornerstone of his investment strategy, providing a unique lens through which he evaluates the sustainability and competitiveness of a business. In this segment, we'll deep dive into the idea of economic moats, exploring the various types and understanding why they're crucial for Buffett's investment decisions. An economic moat, in essence, is a competitive advantage that allows a company to maintain profitability and fend off competition over the long term. Buffett often likens these moats to the protective barriers around medieval castles, making it challenging for rivals to breach and providing a lasting advantage. Let's explore some common types of economic moats and how they contribute to a company's resilience. Brand power. A strong and recognizable brand is a powerful economic moat. Companies like Coca-Cola and Apple have built brands that evoke trust and loyalty among consumers, making it difficult for competitors to gain similar market share. Cost advantages. Businesses that can produce goods or services at a lower cost than their competitors have a cost advantage. This might come from operational efficiencies, access to unique resources, or scale advantages. Walmart, for instance, excels at cost leadership in the retail sector. Network effects. Companies that benefit from network effects have a moat that grows stronger as more people use their products or services. Think of social media platforms like Facebook. The more users they have, the more valuable the platform becomes for everyone. Switching costs. When it's expensive or inconvenient for customers to switch to a competitor, a company benefits from switching costs. This could be due to contractual obligations, the need for specialized training, or proprietary technologies. Oracle, with its complex enterprise software systems, is a good example. Regulatory advantages. Some companies benefit from regulatory moats, where government regulations create barriers to entry for competitors. Pharmaceutical companies, for instance, often have exclusive rights to produce certain drugs for a specified period, creating a temporary but significant advantage. Buffett's keen eye for identifying these economic moats has played a pivotal role in the success of Berkshire Hathaway's investments. When he looks at a company, he assesses the durability of its competitive advantage, aiming to invest in businesses that can withstand the test of time. As an investor, understanding economic moats allows you to identify businesses with a sustainable competitive edge. When selecting stocks, consider the strength and nature of a company's economic moat, as it directly impacts its ability to weather economic downturns and maintain profitability. By incorporating this aspect of Buffett's investment philosophy into your own strategy, you can make more informed decisions about the long-term potential of the companies in which you invest. Economic moats serve as a protective shield, allowing your investments to thrive even in the face of competitive pressures, a key principle in Buffett's playbook for successful investing. 5. The importance of continuous learning. Warren Buffett's success as an investor extends beyond financial acumen. A significant part of his enduring success can be attributed to his unwavering commitment to continuous learning. In this segment, we'll explore why Buffett places such a high value on ongoing education and how you can integrate this principle into your own financial journey. Buffett's belief in the importance of continuous learning is encapsulated in his famous saying, "The more you learn, the more you earn." This mantra reflects a fundamental truth. In the ever-evolving landscape of finance, staying informed and adapting to change is not just beneficial, it's essential. One of the primary reasons Buffett emphasizes continuous learning is the dynamic nature of markets. Economic conditions, industry trends, and technological advancements constantly reshape the investment landscape. By staying informed, you position yourself to make well-informed decisions in response to changing circumstances. This is not about predicting the future but being agile enough to adjust your strategy as the financial environment evolves. Moreover, Buffett's commitment to learning extends beyond financial markets. He is known for his voracious reading habits, consuming a wide range of literature from business and economics to biographies and history. This broad knowledge base enables him to draw insights from various disciplines, offering a more comprehensive perspective when assessing investment opportunities. As an investor, you can follow Buffett's lead by dedicating time to continuous learning. Stay updated on financial news, economic indicators, and industry reports. Understand the factors that influence the markets and the companies you invest in. But don't limit yourself to financial knowledge alone. Explore adjacent fields, gain insights from successful individuals in various industries, and nurture a curiosity that extends beyond the realm of finance. The technological landscape is also a crucial area for ongoing learning. In an era where fintech, artificial intelligence, and blockchain are shaping the financial industry, being tech-savvy can give you a significant edge. Buffett himself acknowledges the importance of understanding the businesses he invests in, and in today's world, technology is a fundamental aspect of business operations. Continuous learning also serves as a hedge against complacency. Markets are unpredictable, and successful investors recognize the need to adapt to changing conditions. By adopting a growth mindset and viewing challenges as opportunities for learning, you position yourself to navigate the inevitable ups and downs of the financial markets. In conclusion, Warren Buffett's emphasis on continuous learning is not just a piece of advice. It's a guiding principle that has played a crucial role in his success. By staying informed, adapting to change, and fostering a mindset of ongoing education, you can enhance your financial decision-making and position yourself for long-term success. So, as you embark on your financial journey, remember the words of Buffett: the best investment you can make is in yourself. Keep learning, keep growing, and watch as your understanding of the markets and your financial acumen evolve over time. As we conclude our exploration of Buffett's ways, how to make money work hard for you, we hope you've gained valuable insights into the mindset and strategies of Warren Buffett. Remember, successful investing is not just about picking stocks. It's about developing a long-term perspective, focusing on quality, and continually educating yourself. If you enjoyed this video, don't forget to like, share, and subscribe for more content on wealth-building strategies. Thank you for joining us today on the Financial 911 channel. If you have any questions or topics you'd like us to cover in future videos, feel free to leave a comment below. Until next time, happy investing and making your money work hard for you.